Start with the core question: who pays the income tax? With trusts, it's usually one of three taxpayers: the grantor, the trust itself, or the beneficiaries. On the EA exam, they'll hide the answer in one fact: who has control and who actually receives distributions. If you can sort trusts into grantor versus non-grantor, the reporting path becomes much easier. A grantor trust is a real legal trust under state law, but for federal income tax, it's basically ignored. Think disregarded entity. The grantor created it and kept enough power or control that the IRS taxes the income right back to the grantor. The classic example is a revocable living trust. It may have its own bank account, but the income still lands on the grantor's return. Revocable trusts are grantor trusts because the grantor can change the trust or end it during life. That's the benefit: control and flexibility, often used alongside a will. The drawback is the trade-off. Because the grantor kept control, those assets are generally still included in the grantor's estate at death. EA exam tip: if you see revocable, your default is grantor trust taxation. A non-grantor trust flips the logic. The donor gives up control, so the trust becomes its own taxpayer. That means the trust files Form 1041 and computes its own taxable income. Then comes the big exam-tested idea. When a non-grantor trust distributes income, the beneficiary generally picks it up as taxable income, and the trust issues a Schedule K-1 to show what flows through. Here's the clean way to visualize the flow. The trust earns income. If it keeps the income, the trust pays the tax. If it distributes income, that income usually carries out to the beneficiary, and the beneficiary reports it using the K-1. A tempting wrong answer on exams is distributions are always tax-free. Not for trusts. Distributions are often the mechanism that shifts taxable income out to beneficiaries. Common non-grantor examples show up a lot. Irrevocable trusts are the big one. Once created, you generally can't revoke them, and transferred property may be outside the gross estate. Qualified disability trusts are non-grantor trusts for a disabled beneficiary under age 65. And charitable trusts are always irrevocable, used for charitable purposes, and they're not subject to the net investment income tax. Memorize those labels. They're easy points. The executor of a decedent's estate chooses the estate's accounting period based on which statement. The choices include: it must be a fiscal year based on date of death. The executor can choose calendar or fiscal year when filing the first return. It must be a calendar year unless IRS approval is received, or it must be a fiscal year based on date of birth. Think about it. The correct answer is: when filing its first return, the executor can choose the calendar year or a fiscal year. An estate is allowed to adopt either accounting period, and the choice is effectively made on the first Form 1041. The tempting wrong answer is the date of death forces a fiscal year idea. Date of death starts the estate, but it doesn't lock the accounting year. Harrington died April 10th. After his death, his brother Ethan receives these items of income in respect of a decedent: unpaid wages of $13,500, unpaid rental income of $1,000, municipal bond interest of $750, and a $1,000 short-term capital gain from a stock sale Harrington made before death. How much taxable income must Ethan recognize, and what's the character? Think about it. Correct answer: $14,500 of ordinary income and $1,000 of short-term capital gain. IRD is taxable to whoever receives it, and it keeps its character. So wages plus rent are ordinary income, and the stock sale stays short-term capital gain. The tempting trap is including the $750 of muni interest as taxable IRD, but tax-exempt interest stays tax-exempt, even when it's IRD.